Hi, Larry Gaines, Power Cycle Trading. Well, one of my favorite trade setups or trading patterns is what we call the volatility compression squeeze. So this is on Alibaba, and you can see here this is a 4-hour time frame. So you can see how tight this price action is. You can just kind of see it through here, just kind of coiling. You could call this kind of a bull flag pull up here, and then just prices coiling sideways. So it's looking to potentially break out either up or down, and a lot of times this type of pattern offers a very explosive move either up or down. So what we want to do is look for potential direction, and we do that based on momentum. So down below is what we call our momentum flow indicator. So right here where you can see my crosshairs, you can see that the momentum flow here, you've got 4 different rows, basically 5, and they're all green. So the momentum over these time frames that we're looking at is pointing to an upside move. Now, the problem with the markets right now is that you've got some uncertainty in Europe, but also you've got the potential for a seasonality trend or shift to the downside next week, so it makes the markets a little bit treacherous to trade. So let's take a look at seasonality. So this is a seasonality continuation pattern chart for the NASDAQ 100. And you can see that this goes back 5 years, 15, and 20 years, or 22 years. So you can see the trend is generally for the market in June to be down on the NASDAQ. So pull back and then just really choppy. So, based on this type of information, when you're looking at very specific trade setups that are to the long side, I like to look at trades that are very, very well hedged. So, for example, BABA, what that trade setup we did was convert that to what we call a long call Condor. So the original trade setup, the setup that we did yesterday, was buying the June 15 series. This is the monthly option, the 202.5, 207.5 call debit spread. So did that after an adjustment for $1.80 debit. Okay, so the maximum at risk then is $180. The maximum potential theoretical profit if it closes above that short strike of 207.5 is 320. So it's got a really nice risk reward ratio. Now, the market you can see here is kind of churning sideways. Now, if this was to stall out, we can hedge this trade by either selling, we could sell the 210 by the 215 bear call credit spread, so be selling that short strike up here where my arrow is. You could do that and bring in $57, so that would reduce your credit or reduce your at risk of 180 down by 57. So drops your risk down to 123, but you still have a nice profit zone up here where theoretically, if it closes between this short strikes of the call debit spread 207.5 and the 210, you'd make $377 on risk of 123. So this is what we call a conversion to a long call Condor. So it's a good way to buy time and also reduce risk.